Time for All Things Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now, with this week's program from D.L. Blain and Company in New Bern, here's David Blain.
Hello, I'm David Blain, and welcome to All Things Money. For the next 30 minutes, we'll take an educational, stimulating, and entertaining look at issues affecting your money. We'll give you information and actionable ideas to help you create or maintain wealth, and give you some information also hopefully to save some money on taxes from time to time. Remember, the show is about you and your money, so if you have any comments or questions, feel free to give us a call at 633-0107, or you'll find us on the web at www.dlblain.com. That's DLBLAIN.com. And our email address is allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. And if you have any questions or comments on today's show, feel free to shoot us an email or give us a call. If you missed previous issues of the show, please go to our website. That was www.dlblain.com. And you can check out archives of all the previous shows. On today's show, we're going to discuss some implications, mostly about asset allocation in light of the 2008 bear market, as well as the past 10 years that have been less than stellar for the equity markets. But before we do, I'd just like to mention one thing. My son plays on the New Bern 9 and under All-Star team, and this past week they competed in Winterville, North Carolina, in the state Cal Ripken League Championships. They finished second to the good team out of West Raleigh, and that qualified them to go to the regional tournament in Virginia starting next week, where they'll play teams from all over the eastern United States. And so I just wanted to congratulate them for a job well done and wish them good luck. I do know that the team through the New Bern Baseball League here in New Bern, they are looking for sponsors to help them make this trip. If it's something you'd be interested in, feel free to contact me at the office or by email. But once again, congratulations to the New Bern 9 and under Cal Ripken League runner-up in the state championships. Okay, on to our show today. Since World War II, the U.S. economy has expanded at a fairly decent rate, but the last 10 years have been somewhat of a fizzle. The GDP only grew at an annual rate of 1.8%. Disposable income grew at about 2.5%. And, of course, as we all have probably heard by now, the S&P 500, the proxy for the United States stock market, declined about 1% between 2000 and 2009. So the point of today's show is we want to talk a little bit about what lessons should you have learned from this time period. And the first thing is that long-term predictions, especially about the future, you notice the humor there, predictions especially about the future, I think that was somebody famous said that, but anyway, are seldom reliable. And I doubt that anyone in 1999 or 2000 could have reliably predicted the terrorist attacks of 9/11, two wars, the size and scope of the housing bubble, or the resulting financial meltdown. Oh, by the way, that was Mark Twain, I think, who said that predictions, especially about the future, are seldom reliable. So to be successful, you have to be able to take a look at the historical record of investments, as well as evaluate what's currently happening in the economy, and then make informed, thoughtful decisions about how to invest. After the tech bubble burst in 2000, we realized that these hot tech stocks can fizzle as quickly as they can catch fire. And prior to bubble bursting in the real estate market, people felt like, and you heard a lot of housing is a safe alternative to the stock market, and people poured money into the real estate market, and we saw that bubble up. And people started bidding up companies like Microsoft and Google and some of these companies to stratospheric levels. And this is never a good idea to invest your future all in one type of investment or one type of stock. The last 10 years also, we've noticed that diversification, it still works, but some people have a confusing notion of diversification. And diversification does not mean investing in Microsoft, Apple, Google, Cisco, and things like that. All those companies are U.S.-based technology companies, so you're not really diversifying at all. We also saw the rise of the advent of the exchange-traded fund, or ETF, that allows you to diversify across hundreds or even thousands of companies with one individual security. As markets, the past 10 years, we've seen increasing correlations, meaning that international companies and U.S. companies in times of crisis move together. However, the past 10 years have been a great time to be an investor in things like emerging markets, gold, treasuries, bonds, things like that. And so it goes back to the most important decision that an investor has to make is how they allocate their assets. And simply the most basic decision that we look at is the allocation between stocks and bonds. That's the first decision that has to be made.